you've worked hard for your money, and I want to make sure that your nest egg provides you as much financial security and joy as possible. So in today's video, I'm going to go over 13 bad assets that can make seniors poor. And whether you're 35, 55, or 75, there's something here for you, because if you're young, these bad assets can really dwindle away the growth of your portfolio, and I don't want to see that happen to you. Okay, we're going to jump into an article by Bolden, and it's called "The Unlucky 13 Bad Investments for Your Retirement." And the first one is livestock and commodities, and the author says there is no moo in money. Um, and the point there is livestock. I don't think many of us invest in it, but I did think it was funny. There's no moo in money, but interestingly, my father thought about making investments in alpacas back when I was like 15 or 16 years old. I think he's very glad that he didn't do it. Some people make money, but anything that eats or poops or it takes gasoline can be expensive to upkeep. So that's the first one. The second one is collectibles. Um, Things like, people might collect coins or stamps, or my mother used to collect Hummels, which are little figurines. And if it's something that's fun for you and it's not that expensive, great. But if you're buying it as an investment, boy, you really have to know what you're doing. There are professionals that, it's one of those situations where like the top 1%, the top 3%, the top 5% probably make the majority of the money in that area. The next one is partnerships, specifically oil and gas partnerships or real estate partnerships. This is a little more niche, but it's starting to be marketed towards everyday people. And yes, real estate can provide nice returns. It certainly has historically. And oil and gas offer some big tax advantages, but partnerships are different than how you can invest in the public market. So partnerships are private, and they can be hard to get out of, and they can make your taxes more complicated. The reality is, if an oil and gas partnership or a real estate partnership is being pitched to me, I can't put in tens of millions, hundreds of millions of dollars. So it's probably not the top tier investment. Okay, the next one I want to talk about is complicated investment contracts. And these are private investments where, somebody may offer you, or an institution may say, we're going to give you 80% of the upside of the S&P 500, but limited downside with the S&P 500. So you just want to be careful with these contracts, because the proof is in the fine print. And again, you may have liquidity issues. Okay, so as we're about halfway through the list, and as we look at these things, one of the most important things we do is we plan. You may have noticed that this article was written by Bolden. Bolden also provides software for people to run their financial forecast, to look at their retirement, to do what if analysis. And it's the software. What I recommend for people is to work with a financial advisor. Financial advisors can be expensive, mea culpa. I was a financial advisor for 20 years before I retired. I think they're worth every penny of their cost, but I do know that there's people in my audience that say, "Hey, Azul, I'm just never going to use a financial advisor." If that's you, I urge you, don't use Google Sheets, don't use Excel. It's just too easy to forget some. It's too easy to make a mistake. Use software designed for you. The software I like is Bolden. This video is not sponsored by Bolden, but I am an affiliate. You can sign up here. It's very affordable. They offer a free trial, and then after that, as I record this, Bolden software is $120 a year. Money very well spent. So use this link here. You'll be supporting the channel. I am an affiliate, but this video is not sponsored by Bolden. Okay, let's keep going. The next one this article talks about is specialized funds. And the author says, stick with broad-based and index funds over the long haul. He says you'll do better. There's no guarantee of that, of course. and you'll feel more comfortable. I do think for most people, unless you have specific knowledge of an industry, uh, the general funds are easier to invest and not have to continue to do research on an ongoing basis on. Okay, the next one, number 6, I do have some experience in, which is startups, doing investments in startups. I do like to do a little bit of that, more just to support the next generation. Um, and I like, supporting and seeing the CEOs working so hard. But startups, boy, it's really easy unless it's something you're gonna dedicate your time to. It's something that's easy. A lot of these companies obviously don't make it, and so it's something that could be easy to lose your money on. The next one, this author says is a portfolio of individual stocks. Um, so he's a supporter of index funds. Portfolio of individual stocks can make sense if you have a professional that's good, that's dedicating their time to managing that portfolio. And a lot of people can do it themselves, but it takes a lot of time. You have to be continuously researching it. And I think probably like 10 hours a week per company that you own, something in that area, and you have to do it over a long period of time. So oftentimes people get excited about doing this for a while and they buy their companies, and then life happens and you move on and you don't spend that time, and that can be a costly mistake. So that's the portfolio of individual stocks. The next one is real estate, specifically doing real estate flips. And the author here is just saying, if that's not, again, it takes time. If that's not something you have expertise in, if it's not something you want to dedicate your time to, you might get hurt from an investment standpoint on that. The next one, timeshares. We've all heard of timeshares. I think the reason people buy timeshares is for the memories, but from an investment standpoint, uh, I've never heard of anybody. I'm sure there are people, but I personally have never heard of anybody saying, "Boy, I got a great return, financial return on my timeshare." I have had people say, "Boy, my family's got great memories because we did the timeshares." I would say in the day of Airbnb, you can replicate a lot of the memories that you otherwise could get from a timeshare without having to tie your money up in that. It's also something that the salesperson gets a big commission on. Okay, the next one is illiquid investments, and here's what the author says about those. Antiques, arts, collectibles, timeshares, most partnerships in real estate are not liquid and make poor investment for those that are not otherwise wealthy. And he talks about how he's been in one investment for 40 years and he still can't get the general partner to sell that investment. He doesn't control when that investment is sold. Okay. The next thing he says is don't try to predict the future. This person worked for a Fortune 500 company and they were in strategic planning. And even though that was his job to try to predict the future, he just explained, how difficult it was. And he had access to a lot of resources and was very well trained. But what I think people should do is really have a long-term asset allocation that can work in good times and bad times, so you don't have to be a fortune teller. More on that later. Number 12, I completely agree with free advice. Sometimes the most costly way to put together a financial plan is free advice. 13, he jokingly talks about lottery tickets. Both of my parents used to enjoy buying a couple lottery tickets a week. Nothing wrong with doing that, but if that's your retirement plan, you're probably going to end up disappointed. Okay, so what are my top three? My top three bad assets that can make seniors poor are new cars. The average new car payment is almost $750 a month, and almost 20% of people have a $1,000 a month or higher car payment. That's a lot of money, specifically as you get closer to retiring. If that's your thing, great. You worked hard for your money, but if you're buying a new car every 2 or 3 years, could you wait 4 or 5 years? If you're doing it every 4 or 5 years, could you push it back? So that's one. The next one, I agree with the author here, free advice. can be very expensive. I do think that you want a plan, and that's my third one, is not having a financial plan. Again, if you're not going to work with a financial advisor, I urge you to use software designed for you. Again, the link for Bolden is here. And if you enjoyed this video, the YouTube algorithm says this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. Bye-bye.